In your money this week, the S&P 500 opened up on Monday and started declining. And while we don't always know why the market does what it does, it's safe to say that the Iran conflict and oil prices jumping were the main culprits why. As the day went on, or as the morning went on, the market started to recover and eventually turned positive with seemingly no reason why, no updates on the war. And I half joked to some friends of mine that if the market stayed positive for the day, and we heard later on that there was a positive war update, I would think that there were some market participants who got the news a little bit earlier than the rest of us. And lo and behold, later that day, President Trump told, I believe, CBS News that the war is very near complete. Obviously, that didn't turn out to be the case. The positivity didn't hold as the S&P 500 was down about 2% for the week, and it's now down closer to a little bit more than 5% from its all-time recent high. Small caps were also down about 2%, and international markets were hit harder. The yield on the 10-year jumped to around 4.3% as investors have sold off bonds along with stocks recently, and they haven't gone to this flight to quality and this mild so far sell-off in stocks that we've had. I've discussed recently on the podcast as well as this channel that I think that it's been driven by inflation concerns, the bond sell-off, and liquidity concerns, which is why we're seeing both markets, stocks and bonds, decline at the same time. So there's a lot you can get into after a week like this. I want to focus on three things. One, we're starting to see some forecasts about how this conflict could impact the economy. They're good to dig into, not because they're necessarily going to be right, but it's good to understand consensus expectations, since if things come in better or worse, that is going to move the markets. Want to dig into the stagflation talk we've been hearing more about. And I want to touch on this notion that there isn't anywhere for investors to hide with stocks and bonds both down. So let's get rolling. The economy. The recession still isn't the base case from the research reports that I've read, but oil prices are key, especially given where inflation is right now. So oil was at about $65 a barrel when this conflict started. If it stays around 100, consumer spending will be hit, and it'll more than offset the benefits from last year's tax package, according to estimates. So slowing down the economy. Higher than this, let's say oil in the 125 to 150 range or worse, we could see multiple quarters of economic contraction and a recession. So key to how oil prices are going to be is what's happening in the Strait of Hormuz. According to a Bloomberg economics forecast, a 1 month closure gives us oil around 105. So touching on that earlier scenario where consumer spending will be impacted, but not necessarily recession. If the strait's impassable for 3 months, prices would be higher than that 125 to 150 threshold that I mentioned. And we would or could see a recession if you stack those forecasts together. So, for a variety of reasons, much more on the humanitarian side, which isn't the focus of these updates, I acknowledge, we need this conflict to not drag on for months, or else oil prices will stay high and push the US into a recession. Which brings us to stagflation, another one of those things which makes the 1970s sound like a generally awful time, since that was the last time we really saw it here. Stagflation, high inflation, weak economic growth, elevated unemployment. Right now, inflation is above the Fed's 2% target. January core PCE inflation came out and it was at 3.1%. That's the Fed's preferred metric to follow. High oil prices aren't going to make inflation better anytime soon. Q4 GDP was revised downwards to 0.7% growth. And we've been in a weaker labor market for a while. So again, stagflation, high inflation, weak economic growth, elevated unemployment. You could say check, check, check based on the things that I just mentioned. But I don't think we're going back to the Bee Gees era anytime soon. This is where how much we've turned into an oil producer helps us. And just going back to the initial points that I made, the conflict would have to persist for months more for the economy not to have a quick rebound after oil prices drop. Inflation is sticky, but was heading in the right direction. And while we're not creating many jobs, unemployment at 4.4% isn't high, although, again, the labor market isn't in great shape. And that is something we need to focus on when this conflict is over. Which gets me to the third thing I wanted to mention. Stocks and bonds are down, so there's nowhere for investors to hide. It makes for a great headline and talking point if you're into that kind of pointless pessimism. But what are you hiding from exactly? Market volatility is normal. Your portfolio doesn't need to make money every day or every week or even every month. Thinking that it does leads to mistakes. Following people who focus on where to hide daily or weekly also leads to mistakes. So just ignore it and move on. So that's where the market was this week and what I thought it mattered for you as you followed the news. I want to wrap up with two things. One, some quick thoughts on private credit, and the second, a financial planning topic. Private credit, you're seeing news about private credit funds gating investors, meaning that they're capping how much investors can withdraw from their funds. And people are connecting this to some broader private credit concern story that's been going on. I've already touched on it here. I do believe it's overblown. But even if it's not, I just want you to understand what's happening with these funds and why I don't think this gating necessarily fits into that broader concern. These funds are called interval funds. They're a newer type of mutual fund that investors can access, usually through advisors that provide limited liquidity compared to daily liquid mutual funds. The liquidity windows are quarterly because they're investing in assets that are not liquid: private real estate, private credit, reinsurance, private equity, just to name some common examples. These are things you used to only be able to access through limited partnership vehicles that provided no liquidity typically for years. The interval funds provide quarterly liquidity, so more, obviously, than the limited partnership vehicles. And now you can argue whether these funds belong in individual investor portfolios or not. I happen to think they can add value when used the right way at the right time and in the right size within a portfolio. But what I want to focus on here is that these funds that are limiting redemptions are doing what they're set up to do. None of this should have been unexpected by their investors, and gating redemptions is a legitimate way to protect the remaining shareholders in the funds from investors fleeing or panicking. I'm not saying that there aren't any issues with these funds. I haven't gone fund by fund. I'm just trying to share, since people are trying to draw 2008 parallels with the private credit market, that when I hear these concerns about gating being lumped into everything else that's going on, I think that's a reach given how these products were designed. And then finally, on the planning side, I shared an update in my Wednesday reading list on how to think about long term care expenses during retirement. I won't reread it here, but the main point is that there is an average figure of 135,000 that you do need to plan for. But the planning needs to be taken further, as where you live and your personal situation can vary the cost dramatically. I continue to think, after working with clients for over 25 years, that people are under planning for these expenses. And if you're approaching retirement, you should get educated on long term care coverage options and incorporate them into your financial plan. As always, please like the video, subscribe to the Boston Advisor YouTube channel, and check out thebostonadvisor.com for more content. Thank you for listening.